Rachel Reeves approves tax crackdown on UK savings accounts. Breaking news. UK Chancellor Rachel Reeves has approved a major tax crackdown on savings accounts, a move set to affect millions of people. Before we continue, please subscribe and turn on notifications so you don't miss updates that could impact your finances. The government says this change is about fairness. With interest rates rising, more savers are earning above the personal savings allowance, the amount you can earn tax-free. HMRC believes too much interest income is going untaxed, so new rules will require banks to report more data directly to the tax office. This means if you've been enjoying high-interest savings, you could receive a tax bill. Reeves insists this isn't about punishing savers, but making sure everyone pays their fair share. Critics say the plan could discourage saving during a cost-of-living crisis. Supporters argue it will bring in hundreds of millions of pounds for public services. Experts advise checking your interest earnings now and considering ISAs or other tax-free accounts to reduce your bill. Whether you're in London, Birmingham, Manchester, Edinburgh, or Cardiff, this change could affect your wallet. What's your view? Fair move or extra pressure on savers? Share your thoughts in the comments. If this update helped you, please like, subscribe, and share so more people can stay informed. This development has made many people sit up and pay closer attention to where and how they keep their money. Savings accounts have long been considered one of the safest ways to store funds, while earning modest returns. However, with the Bank of England's interest rate adjustments over the last few years, returns on savings have grown higher than in the previous decade. While this might sound like good news for savers, it has also caught the attention of HMRC, which now wants to ensure that all due taxes are properly collected from this source of income. Financial experts are already advising savers to review their accounts, particularly those with high balances that generate significant interest. With the personal savings allowance remaining unchanged for most taxpayers, many individuals could unexpectedly find themselves liable for tax on their interest earnings. This has raised the importance of tax planning, not just for the wealthy but for anyone with substantial savings. It is no longer enough to assume that interest income will go unnoticed by tax authorities. Digital banking records, improved reporting systems, and more sophisticated monitoring tools mean HMRC can track interest payments with ease. One of the central arguments from the Treasury is fairness. Reeves has emphasized that while working people pay taxes on their wages, those earning substantial amounts from savings interest should also contribute their fair share. This is a message aimed at countering the perception that tax policies only target salaries and small businesses, leaving passive income sources largely untouched. Supporters of this policy argue that it is about closing the gap between different income types and ensuring the system is not skewed in favor of those with more financial assets. Another concern is the timing of the announcement. Many households are still dealing with high living costs, and while interest income has gone up slightly, inflation has eroded much of the real benefit. For some, paying tax on this income feels like an extra blow when they are already struggling to keep up with everyday expenses. That said, there are also opportunities for savers to adapt. Financial planners recommend exploring tax-efficient savings vehicles, such as ISAs, individual savings accounts, which allow interest to be earned tax-free up to a certain limit. For those who haven't fully utilized their ISA allowance, this could be the perfect time to move funds into such accounts, to shield them from the new tax implications. Others are considering shifting their savings into mixed investment portfolios that balance risk while still generating competitive returns without attracting as much taxable interest. Technology will play a big role in this transition. With AI-powered personal finance apps becoming more sophisticated, individuals can now track their savings interest, calculate potential tax liabilities, and receive automated alerts. Don't forget to subscribe.